Good morning. It's Wednesday, the 20th of March, and this is Govindraj Ethiraj broadcasting from Mumbai, India's financial capital. Our top stories and themes that we are tracking today. The stock markets fall 736 points. The Sensex has erased most of its gains of 2024. Japan raises interest rates to zero, ends a negative interest regime after 12 years. Oil heads above $87 a barrel, and why and how India's import bill is rising. Retail sales of gold slow sharply on record high prices. And India chokes again with 9 of 10 world's most polluted cities.
This is a core report with Govindraj Ethiraj.
Markets fall, the Sensex erases most of 2024 gains. Now, we've noted the exhaustion from stretched valuations in the core report yesterday, that's Monday. On Tuesday, Indian equities fell again as there were no clear upward triggers, even as some of the negatives, including the market regulator SEBI or Securities and Exchange Board of India's crackdown on mid-caps and small caps, continued to weigh on sentiment. The BSE Sensex fell 736 points to end at 72,012, while the Nifty 50 was down 238 points at 21,817. Now, at this level, the Sensex is fairly close to its January 1 start figure of 72,271, having thus erased all the subsequent gains or most of the subsequent gains of the year. Predictably, IT services major Tata Consultancy Services or TCS was the biggest laggard on the benchmark indices, and it was down about 4% after its parent, that's Tata Sons, sold about 0.6% stake in the company. So now JPMorgan Chase and Company, Macquarie Group and Manulife Financial are amongst the firms that have flagged a shift in sentiment on Indian stocks according to Bloomberg. Macquarie analyst wrote in a note citing interactions with investors in Hong Kong and Singapore that recent actions by Indian regulators, that SEBI, have raised concerns amongst investors. Now, this overhang will obviously continue till the froth is weeded out, which means that the mid and small cap stocks are unlikely to rise as such, even if they don't fall further. Now, how much is froth, of course, is a subjective question, but it's got a way to go. Market watchers like G. Chokalingam, who's been talking to the core report, and leading brokerages are zeroing in on specific stocks, which of course makes sense, but it can be confusing to many, I suspect, first-time investors who are often not researching their buys. Japan finally raises interest rates to zero. A nearly 12-year run of negative interest rates has ended with the Bank of Japan moving its key policy rate to at least zero. Now, this was the world's last negative interest rate, ending the most aggressive monetary stimulus program in modern history, while also indicating that financial conditions could stay accommodative for now, Bloomberg reported. The new policy rate range would be between 0% and 0.1%. Shifting from a minus 0.1% short-term interest rate, according to a statement at the conclusion of the Bank of Japan's two-day meeting on Tuesday. A weaker yen that came out of this pushed up the Nikkei 225 stock average to reclaim the key 40,000 level. So the negative interest rate regime is something that has been discussed widely by experts and non-experts alike. The Wall Street Journal says the negative rates after a delay contributed to driving the yen down and import prices up, thus fueling the return of inflation. Now, despite some adverse effects, banking systems did not totter as feared, says the Wall Street Journal. Negative rates were an outcome of the global financial crisis of 2008, which caused many advanced economies and put them into a deep freeze, or also called a secular stagnation. Even after pushing interest rates to zero, central banks struggled to generate what they viewed as a healthy level of inflation, says the Wall Street Journal. So if you've not been following this too closely, we do need some inflation at all points of time. Now, how much, of course, is a subjective issue. In 2012, Denmark's central bank imposed negative rates on deposits held by commercial banks, followed by the European Central Bank in 2014 and the Bank of Japan in early 2016, as well as Sweden and Switzerland. In theory, according to the International Monetary Fund, a negative rate policy supports economic activity and inflation through the same channels as conventional interest rate cuts. The Wall Street Journal says that this year, many companies in Japan used strong profits to give raises of more than 5% to workers. Inflation, pushed up by import prices, is now running above 2%, This was justification for the Bank of Japan to end its negative interest rate policy. Oil prices are now inching towards the $90 mark. Oil prices are holding after hitting a near 4-month high. Oil has also broken out of a range it was moving in for several months, as we've been reporting on the core report. Brent oil was quoting around $87 a barrel overnight, and these are numbers not seen since November thanks to supply cutbacks and signs of demand surges from both China and the United States. Bloomberg reported that crude was now on course for a third monthly advance after breaking free from the narrow range it had been trading in for much of the year. As we've been saying, the OPEC, or the Organization of Petroleum Exporting Country Plus, supply curbs have sent up prices. About 600,000 barrels of Russia's daily refining capacity has been knocked out, according to the Gunvor Group Ltd, quoted by Bloomberg. This is because of drone attacks from Ukraine. Back home, what do higher oil prices mean for India and Indian refiners, or for that matter, consumers like you and me? Moreover, India has benefited from cheaper Russian crude, which may not be easy to come by now because of increased sanctions. As a matter of fact, quite interestingly, a Bloomberg report says there are 2 tankers carrying Russian Urals crude which have been anchored off Gujarat for several weeks, and it's quite likely that they will go elsewhere without unloading the oil on Indian ports. I reached out to Harsh Dole, oil analyst and vice president at IIFL, and I began by asking him how he was seeing the oil prices impacting India now and his outlook ahead.
I think if you analyze the broader oil markets, the run up in the oil price is more got to do with supply curtailment rather than runaway increase in the demand. As quoted by one of the CMDs of the oil marketing companies, enthusiasm of oil exporters to continue with production cuts for a long time may actually be self-defeating. So that means if they continue to kind of throttle the supplies, they're making the alternative fuels much more viable. And to that extent, the strategy of throttling the output may not actually work in long run. And moreover, because OPEC is having reasonable amount of surplus capacity, which they can always open gates and supply in case oil runs up. So to sum it up, I think it is the supply curtailment which is leading to some rally in the oil price. In my opinion, unless the demand improves materially, there is no great leg to this rally.
Right. So you're saying that prices could edge down, but even at, let's say, if they are in that 83 to 86 range, where does India stand?
See, India has been to that extent quite smart, and the policymakers have actually first ensured that even if there is a supply disruption across the globe, our refineries don't run out of fuel. And last time they kind of opportunistically sourced oil from Russia, Iraq, Venezuela, wherever possible. And in my opinion, that strategy will continue. First is to ensure energy security, for which they will tap even US if required, and even if it means that it comes at a slight premium to the erstwhile Russian oil. So first is to ensure supply continuity. Second is to basically squeeze the suppliers and try to get a discount relative to the grade of oil that you are actually procuring. So once the base supply is ensured, in my opinion, negotiations will start to ensure that we possibly get the best price. So perhaps for a month or a couple, one might see some increase in oil price. But hey, again, couple of dollars here and there is a better price to pay rather than actually not having oil.
Right. Specifically, Russian crude, which we've been importing in large amounts and which we are not able to or will not be able to as much because of increased or heightened sanctions. One report I can refer to from Bloomberg talks about 2 tankers carrying Ural crude, which have been idling off the west coast of India for more than 3 weeks without any indication of when they will unload or where they'll go. I guess that's what we're seeing. But the larger point is that if Russian crude is not available to us and at a lower price, what does this mean for our import bill? That's one. And the second is, logistically, how are we filling the gap?
So I'll take the second one first. Well, it's not that world doesn't have oil. I mean, US has turned out to be a surprise swing supplier, particularly the US shale. And to that extent, even if we don't get oil from Russia, I think I was reading a report in Business Standard today, which says that India has been able to get more oil from US. So if not from Russia, then probably we'll get oil from US. The only question is, the freight cost. While Russia was selling oil to India at a discount, the net saving was not that material, more than maybe a few dollars, because the freight cost had actually gone up disproportionately. So while headline number looked really eye-popping that Russia is offering at a huge discount, the net impact was actually maybe few dollars relative to the Brent that was the discount, and that was actually pushing up the refinery margins for the oil marketing companies as well as companies such as Reliance, Naira, etc. So to that extent, 40% of such benefit will actually go away and probably be in sync with what our oil cost was maybe a couple of years ago.
Right. That's interesting. So, if you were to look ahead now, Harsh, how are you seeing, again, from an India point of view? Because we've seen a reduction in pump prices of petrol and diesel by 2 rupees, edging up of oil prices globally, and I'm assuming to India as well, whichever way the basket is configured. How could this play out?
Interesting. So I think one event that possibly we should also record here is Ukraine has been consistently attacking on Russian refineries. And we did a quick analysis of that event. And we found out that currently 15% of Russia's capacity is basically at risk. Were this 15% capacity were to go to 50%, i.e., Ukraine constantly bombarding, then probably nearly 2 to 3 million barrels of oil product exports that Russia does will be at risk. And that in global consumption terms is nearly 3%. As such, oil markets are fairly tight. And, further curtailment of products from Russia may push up the refinery margins. So that means that the standalone refiners and the refineries of oil marketing companies will gain, but there may be squeeze in terms of their marketing margins. So, it all depends what kind of business configuration you have. If you have a balanced portfolio, you are neutral, but somebody who's having a long marketing portfolio maybe end up hurting. Guys like Reliance or Naira or a Chennai Petro or a standalone refiners, to that extent, may gain hugely if there is a spike in refinery margins. So it all depends on what revenue model you have. And to be fair, I think until elections are over, looks like pump prices may continue to be frozen because let's take practical view. Nobody will want to push up the pump prices till the election outcome is done.
If things are as they are right now, how do you see overall crude prices, or rather, do you see crude prices edging downwards, as you said earlier, because of supply reasons, or rather demand being weak? Or are you seeing any other trend or any other underlying actions or potential actions that could change the course of things?
Over the next 12 months, I'm working with a Brent which should average between 75 to 85. And that should actually work well for OPEC as well as consumers like India and China. However, in short term, there are quite a few factors which determine the price of the crude, which could be speculative buildup of position by the hedge funds in the US or temporary curtailment of supply, etc. However, if you take a 12-month view, I think unless there is a runaway increase in demand, I expect the oil prices eventually to gyrate and range anywhere between 75 to 85 to a barrel.
Right, Harsha. Thank you so much for joining me.
Pleasure.
Retail sales of gold slow down on high prices. Gold prices, which also we've been talking about for a while, have now eased back a little after touching record highs last week, including about 66,356 per 10 grams on the multi-commodity exchange. In international markets, gold futures had touched over $2,200 an ounce last week before steadying. So the trigger for gold prices rise is a bet that the Federal Reserve will cut interest rates earlier than expected, though a higher than expected inflation number a day later calmed investors. Now, what is the outcome of impact of these high prices on Indian markets? Also, gold imports shot up in February 2023 to $6.1 billion, according to latest figures from the Ministry of Trade, versus about $2.6 billion for the same month last year. So I'll repeat that: $2.6 billion in February 22 and $6 billion of gold imports in February 23. I reached out to Surendra Mehta, National Secretary of the more than a century old Indian Bullion and Jewelers Association, which also sets benchmark gold rates across India. And I began by asking him how he was viewing overall bullion prices and also its impact on the jewelry market.
Early reaction on the expectation that Fed would cut an interest rate. That is the major thing which is driving or which is making the gold bullish. The second reason being there have been few instances of central bank buying in some of the countries like Iraq, Iran, which are small countries in comparison to China, US, and India buying. So that can also be one of the reason, but not the major reason. But we have not seen any ETF buying and slight geopolitical tension in the Middle East. So these are the factors which are driving the gold prices in the last 1 month.
We've seen a big spike in imports of gold. Gold imports are at about $6.1 billion for Feb 24 compared to about $2.6 billion for Feb 23. So this seems unusual considering that there is no other visible trigger. Why is this happening?
Well, it is very surprising also to us that why it is happening. But the important factor is if you look at full quarter, that is the January to March quarter. So this is just compensating the earlier months downfall in the gold imports. So we do not see any major reason for this thing. Also, we have to understand that the prices have gone high. There will be at least 20 to 30% rise in the import bill due to price rise. But otherwise, I don't see any major.
What usually happens, so when prices go up, obviously global prices go up, does that cause or lead to an increase in imports?
No, what happens basically is when the Indian prices goes up and when it goes up with such a solid speed, there is a rush to import more gold and to store the gold so that bullion dealers and jewelers can make money. There doesn't seems to be any reason, but whatever this import is being done, it's being very, very risky. And most of this import, I presume, would be used for the export.
And I'm going to come to outlook in a second, but what's the current sentiment on the jewelry side? Because usually when prices go up, we see people coming and selling and then slowing down purchases as well.
If you ask me, retail segment customers are missing from the jewelry shops. I can very clearly say that there is downfall of at least 55 to 65% downfall in the retail segment. The major reason being year ending March, high prices, no marriage season beyond Holi. Normally, during the Holi period, there is very little buying because these days are not considered very auspicious.
But this would have been the same last March as well, right?
Yes. But last time during the month of post Holi, there was a wedding season. But this time there is no weddings.
Right. What's your outlook? So you've already said in some ways what the outlook for March is because of the lack of a wedding season. But if you look a few months ahead, what's your outlook for gold prices and demand?
Well, it all depends on Fed decision about the interest rate. They are going to have a meeting Wednesday night. If the Fed decide to cut down the interest rate, probably we'll see another rally of $40 to $50. If they decide not to cut down the interest rate or not to raise any interest rate, then we can see a correction, which will not be a major, but maybe about $40, $50 correction. But if they decide to cut interest rate, if they don't decide to cut interest rate, then we can see the fall of about $140, $30 at least.
Right. Mr. Mehta, thank you so much for joining me.
Thank you.
India is choking once again. 9 of the world's top 10 most polluted cities of 2023 were in India, with Bihar's Begusarai town earning the dubious distinction of being the very worst, according to the World Air Quality Report released by the Swiss organization IQ Air and reported by Bloomberg. Delhi was the most polluted capital city in the world, with an average PM 2.5 of 77.4, coming in 6th on the overall list. India is also emerged as the third most polluted country out of 134 countries. The quality of air in 2023 has worsened in India compared to the previous year, when India was ranked 8th in the most polluted list, with an average PM 2.5 level of 53.3. In Mumbai, where we live, we've seen far more bad air days than ever before, and on some days, we've had the glorious distinction of beating even Delhi. One of the most common forms of air pollution, PM 2.5, kills more people than any other pollutant that's out there, CEO of the North American division of IQ Air, Glory Dolphin Hammes, said while releasing that World Air Quality Report. The report also found that only 10 countries and 9% of global cities had air quality that met World Health Organization guidelines for harmful fine particle or PM 2.5. PM 2.5 or PM stands for particulate matter, and 2.5 represents its size, 2.5 microns, or 1/30th the diameter of a single strand of hair. And it's these PM 2.5 particles and their tiny size that make them so deadly. India's reservoir levels fall to new lows. India's main reservoirs have hit their lowest March levels in 5 years, government data showed, indicating a possible squeeze on drinking water and availability of power this summer, according to Reuters. The 150 reservoirs monitored by the government, which supply water for drinking, irrigation, and are the country's key source of hydroelectricity, were filled to only 40% of capacity last week, according to that data. In Karnataka, where Bangalore is, which has been reeling under a water crisis, the main reservoir was down to 16% capacity. Water reserves are the lowest for March since 2019, when reservoir capacity fell to 35%, a period which saw southern cities like Chennai run out of water, said Reuters. It is going to be a long and difficult summer ahead. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.